Well, the secret is out for at least those of you who watched my last video on lifetime income and tax benefits. So if you want your fixed annuity to provide you lifetime income and tax benefits, you can put after-tax contributions into your fixed annuity in a Roth IRA account. And as long as that Roth IRA is set up in accordance with the IRS guidelines, you never have to pay taxes again. And you can get lifetime income if the contract is set up as such. But let's take it one step further. Do you remember me talking about the Secure Act? Well, if you've forgotten or you haven't checked out my videos on the Secure Act, I've attached the link in the description below, so be sure to check out those videos to become more familiar about the Secure Act. Now, why do I mention the Secure Act? Well, it's because the Secure Act can have some unintended consequences on an inherited Roth IRA for non-spousal beneficiaries. By the end of this video, I'll explain what those unintended consequences are. Hi, my name is Darlene Hartman. I'm a CPA and financial planner with Money Concepts. For weekly retirement planning and annuity advice, be sure to subscribe to my YouTube channel and hit the notification bell so that you can receive notices anytime I post a new video. Now, let me do a quick refresher on the Secure Act. So a qualified account or a pre-tax account, which can be a 401k or even a traditional IRA, if you put pre-tax contributions into the account, that's where you don't pay taxes on the contributions to the account. The account grows tax deferred during the accumulation period. And then when you start taking distributions from your qualified account, you pay taxes on 100% of the amount distributed from the account. And the IRS does have a required minimum distribution schedule that they use to ensure that you're taking distributions from your qualified account so that the IRS can receive its tax money. Now, prior to the Secure Act, a beneficiary of an inherited IRA could actually stretch the distributions from the inherited IRA over the beneficiary's lifetime. Now, due to the Secure Act, a beneficiary, mainly a non-spousal beneficiary, has to take distributions from that inherited IRA within 10 years, thereby accelerating the amount of taxes that the beneficiary has to pay on the inherited IRA, in addition to mitigating the ability to continue with the generational wealth building. I mentioned earlier that with a Roth IRA, if you set it up in accordance with the IRS guidelines, that you don't ever have to pay taxes again after making after-tax contributions to the Roth IRA. So a Roth IRA shouldn't be subjected to the Secure Act, the 10-year rule, right? I mean, if the point of the Secure Act is for the government to get their tax money sooner, and a Roth IRA does not pay taxes on the amount distributed from the IRA account, then it shouldn't apply. Well, unfortunately, wrong. A Roth IRA is subjected to the 10-year rule of the Secure Act. Leave me a comment in the section below and let me know if you inherited a fixed annuity in an IRA account since the enactment of the Secure Act. Also, if you're enjoying this video, be sure to give me a thumbs up, subscribe to my YouTube channel, and don't forget, hit the notification bell so that you can receive notices anytime I post a new video. Even though the intention for the Secure Act was for the government to receive its tax money quicker on those qualified accounts, there are other consequences of the Secure Act that weren't exactly intended. So one would be the mitigation, if not depletion, of multi-generational wealth. So think about it. If a young adult inherits an IRA as the non-spousal beneficiary, before that young adult had the ability to continue to compound interest, in addition to realizing market growth potential on that inherited IRA over his or her lifetime, because the distributions are stretched over the beneficiary's lifetime. But thanks to the Secure Act, the beneficiary now has to cash out that inherited IRA within 10 years. Another unintended consequence would be with respect to a fixed annuity. So if you set up your fixed annuity to provide monthly payments to the annuity beneficiary, and let's say it's a 30-year period certain and you pass within 10 years, that's 20 years of monthly payments to the annuity beneficiary. But if it's in an inherited IRA account, that beneficiary is going to have to take those monthly payments over 10 years. And if that was a minor or a young adult, that may not have been your intention when you set up that annuity contract. Now, here you are thinking that you were watching my videos to figure out which fixed annuity was the right fit for your retirement portfolio. And then I threw you another curveball. Do you want your non-spousal beneficiary to have no tax consequences from the inherited IRA with respect to your fixed annuity? Or would you prefer your non-spousal beneficiary to be able to continue to build that multi-generational wealth? Because unfortunately, you can't have both for your fixed annuity. So if you're more interested in ensuring that the non-spousal beneficiary has no tax consequences from your fixed annuity, put your fixed annuity in a Roth IRA. But if you're interested in your beneficiary being able to continue to build that multi-generational wealth, put it into a non-qualified taxable account where the only taxes that they'll have to pay will be on the growth of the fixed annuity in the non-qualified account. Also, if you want to ensure that the terms of the annuity contract as you set them up are met with respect to the annuity beneficiary, then you also want to put your fixed annuity in a non-qualified taxable account. If you're interested in obtaining a fixed annuity for the security, certainty, and happiness it can provide you in your retirement, and you need some assistance with respect to what type of an account to put your fixed annuity in, click the link below to apply to become my client. And don't forget, if you enjoyed this video, give me a thumbs up. Be sure to subscribe to my YouTube channel and share it with your family and friends. Thank you for watching. Let's get the conversation started on how you can live your best retirement while not outliving your money.